Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures has continued to move higher as fund participation continues to keep the commodity indexes afloat. You'll notice here some very nice consolidation that occurred inside of the market, and then shortly thereafterwards the market continued to move higher. We have two key spots that we're looking at right now for minimum price objectives for the July corn contract. We believe 415.5 is probably a nice spot for it to touch, and above 415.5 we're looking at 422.5. Either one of those levels can prove to be a terminal spot where we could then see a very good correction coming inside of the market. Also, if you take a look at the tangent to this circular arc, so we would not be surprised to see the market to continue to move higher going into this June 5th to 6th timeline. If this contract's able to break out above the 422.5 number, then the next major area of resistance that we would be looking at is 433 for a potential terminal area for the market to top before heading into a potential very good slide for the summer. The December contract is very close to 416, which is probably a very good target here. And outside of finding some weakness at these current price levels, it's looking like the market does want to float up a bit from here. So it's going to be wise to potentially put stops below the market, below this 360-degree mark, somewhere in the neighborhood of 400 to 402, where we can trail the market on the way up, but not give up very good profits that we're looking at right now. Above the 416 number, the next key resistance number would be 426. And then above that, we're looking at 436.5. So either one of these spots are potentially good resistance points for the market, but in all likelihood, 426 is a good spot to see a top come in, as that would coincide with volatility-based resistance overhead. Here we see for the December contract that the point of control sits at 420. And at 420, we would not be surprised if the market gives you a bit of resistance inside of this area here. So 420 is going to be a very key area for this December contract in particular. Soybean futures continue to move in a consolidative move. Initially, we believed that this May 23rd timeline would be a terminal factor, helping the market to jettison in either direction. Instead, now it's looking like it perhaps may become a midpoint for the market and for it to be sideways about equidistant on either side. And instead, we're looking at maybe for that early June timeline to be the spot where the market actually does jettison from here. As we look at where the market is right now, we see that this natural resistance level continues to be very good for the market. And the natural resistance level, as the market tags up against it, we're looking at a timeline maybe around June 8th or 7th or so for the market to come out of here. Over the next couple of days or going into the end of this week, if the market's able to break above these areas here, then we can see some potential follow through to get above that 1110 number. But for now, 1110 is going to be a key factor or key resistance overhead. Above 1110, the next two resistance levels that we're looking at will be volatility-based bands, which sit at about 1139 to 1140. So as the market breaks out of here, these are the key levels that we're going to be looking toward for some guidance. We've adjusted our data set to encompass the full life of contract data for this July contract of soybean, and what we have found is here, 2 standard deviations above the point of control has been the key area of resistance that the market has been having trouble with. Upon being able to break here cleanly, we're then looking at a nice move, perhaps up to resistance somewhere in the neighborhood of 1100 to 1120. And at this area here, either at this 1 by 1 up or 1 by 1 down angle, which what we mean by the 1 by 1 up or 1 by 1 down is 1 point per trading day increment. As the market makes its advance, we could see the squaring or price and time coming in together and giving us a very natural resistance point here for the market to turn back down from. Until that materializes, we'll simply continue to trail behind the market with key support behind it. But for now, we're looking at key resistance to come in overhead as the market has had some trouble here inside of its consolidation. We have two key spots that we want to have on our radar for the November contract. The first part that we're going to look at is 11.53 3/4, and this is where the market has really had a node. It's been equidistant on either side of its movement here, and now it's looking to break upward beyond up to resistance at about 11.86.5. Upon getting to 11.86.5, the next area then we'd be looking to is 11.20. And so we want to keep these on our radar. And as the market makes its way through each of these increments, we can actually lean on these levels for support or to trail stops behind the market if we are net long. One standard deviation above the point of control is at 1034. And you'll notice that this ended up being a very key threshold or area for the market. It broke back down below it and has since came back up through it. And now we have natural resistance overhead. Upon breaking this natural resistance, we believe that the 1120 to 1126 area again is going to be a very good spot for this market. And if he comes up to this area looking for resistance to happen and perhaps look for a move down into the summer months, depending on where the funds continue to lean with regards to their net long positions. The control that they have right now has been very influential in the markets, and so it's important not to negate their influence in lieu of the narrative that is still bearish for the markets or for the underlying markets themselves. With the exception of a very small timeline in April, the week contract has truly been trapped inside of a consolidation all year long. And you'll notice inside of this movement, we've had very good resistance near 487, and it's had significant support near the 455 number. Until this market is able to significantly break through either side of these support or resistance levels, I believe this consolidation will continue. As much as the market wants to, under the duress of the bearish narrative, looks to really move downward, for whatever reason this 455 has been solid, but upon breaking 455, if it does do that, we should see a significant move to the downside. On the flip side, we've had great resistance at 487, and so the next time up, we're looking at volatility-based resistance overhead. If this market's able to really push through and get beyond that 490 area, that suggests that we may find some strength overhead, not based off of the underlying fundamentals, but really based off of the market being carried by the rest of the indices themselves or the commodity complex and being able to move higher from there. Last week, we shared with you that 457 3/4 was going to be a very important level for the market to get through in order to confirm a move down to either 447 or 433.5. The low last week was exactly at 457 3/4 coincidentally. So when we see events like this occur, it helps us understand that these support and resistance levels are very important to have at the forefront of our minds in our decision-making process. Additionally, we also suggested that if we were net long the market, that we can actually trail below these levels in the event of breaking below so that we do not suffer great losses, but we're able to participate on the upside in the event that these levels hold. The market moving up to resistance near 482 to 487 was very key, and perhaps taking some pricing off near those levels may have been prudent. The market then dropped down very hard from these levels and is now holding the 466 area, and we'll continue to see or monitor what it does from here. But now we have a nice natural support angle that we're leaning against, and so if the market continues to hold up against these areas here, we could see maybe a nice little move back up to resistance near this area again. In any case, the key thing for us here for a producer is to trail below the market here and not give up too much on the way up, but not to be overconfident that the market would move up and protect our potential gains where they come in for us. In closing, we'll take a look at the crude oil trade. Here we had a potential high coming in at about 50.15. And here was that wave 5 top that we thought could come in. We've had a very nice move to the downside today. Intraday, it's been down about over $1. We'll continue to monitor to see this, but this looks like very good confirmation to us with the minimum price objective of about $44, retesting the previous major pivot low back inside the market here. We'd like a stop loss maybe around 51 or so, but we'll continue to see how this guy trades because if we find weakness going into these current prices here, we could see a very nice decline, at least for the next 5 to 6 trading days. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.